If those are being taken out, and those are the faster growing, again, more profitable, more cash flow generating companies, higher quality companies, if you will, that are under levered, gosh, I mean, those are probably the types of companies that have the potential to generate outsized returns for public equity market investors on the small cap side. Once they are removed, then it also gets to, well, the companies that are remaining in the public equity markets for small cap equities maybe are less compelling. And so is this feeding into what we're seeing in terms of the continued underperformance of small cap public equities compared to other parts of the public markets?
Hi, this is Matt Pauker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. Every week, we are here to cover the latest in capital markets, alternatives, and retail investing. This week's biggest news in private markets was probably the take private of EA by a consortium of the Saudi Sovereign Wealth Fund, and a handful of private equity firms, really continuing the trend of large companies either continuing to stay private, like in the case of OpenAI, Anthropic, Anduril, et cetera, or companies that were once public now going private. But actually this week, we want to talk about the other end of the spectrum, which is the impact of private equity on smaller companies. We see this in the numbers, both in the count of public companies broadly, which has been cut almost in half since the mid-90s, about 8,000 public companies in the U.S. in the mid-90s, now about half that, roughly 4,000. But also specifically as you look at the number of U.S. companies with 100 million or more in revenues, which covers obviously a broad range of companies from certainly the largest, but down to smaller businesses, less than 15% of those companies are now available in the public market. So 85% or more are privately held. This is obviously having a distorting effect on a number of areas of the capital markets. But in particular, as we think about smaller companies and the impact on small cap equities, I think that's a really interesting trend.
It's actually one of those things where it's still unclear. The data is out in terms of whether it is truly a consequence of private equity impacting small cap public equities, or whether there are other forces at play. But I think among the data points that are really interesting include what you just shared, which is just from a straight number of companies that are publicly traded versus companies that are private at 100 million in revenue or more. There certainly has grown to be a much larger balance of companies that are private. And then the other end of it is actually just looking at historically, small cap public equities have been known to, over longer periods of time, outperform broader public equity markets, larger cap equities. And that small cap equity performance has really shifted in the past, let's call it decade plus. When you break down the attribution of public equity investments, some factors do show up in more pronounced ways and has given rise to what's known as factor-based investing. Those factors have included, for instance, value or momentum. And for a stretch, small cap was also considered a potential factor because small cap equities have historically outperformed larger cap equities. And so the fact that that small cap factor has really gone away and small cap equities have really underperformed has led to a lot of different hypotheses being put out there in terms of why this could be happening. And one that I think folks are really starting to coalesce around is this idea of, is it because private equity and the types of private equity companies that might in prior periods have been public equity small caps, is it because private equity is really capturing those companies and keeping them out of public markets? And so therefore, just the types of companies in that small cap public equity index has shrunk, and the types of, I'll call it, companies that maybe have the ability to outperform are perhaps even more likely to not be public equities today and are more likely perhaps to be private equity companies. And so that's one of those, I would say, debates that's happening in the background as folks think about, okay, what's happening with small cap public equities? Why is it continuing to underperform? What's happening broadly in terms of the way that private equity is impacting public equity markets, and more broadly, what's happening with companies choosing to either stay private or, in the case of EA, be taken private, because as we've discussed before, it is really onerous to be a publicly traded company. And so it is become, I think, much more visible over time some of the impacts that we're seeing. And again, this is more of a hypothesis that folks are discussing versus truly proven out by the data. But this question of is this one of the more evident and more obvious places where this is impacting public equity markets in the small cap public equities.
So in some sense, I guess, these private equity companies are cherry picking the good small caps. And I mean, I know a handful of private equity investors. You probably know a lot more than I do. They're smart people. And I guess it's not surprising perhaps that they would have an outsized ability to find the diamonds in the rough, the gems, and then target those for going private.
So yeah, I mean, if you think about the types of companies that private equity is more likely to acquire and execute on a private equity strategy. And I think in a future conversation that we have, it might be worthwhile for us to spend a little bit of time in terms of dissecting what private equity strategies look like and how they might execute. But for the purpose of this conversation, really just focusing on the types of companies that private equity is looking for. There are certain types of companies that are going to be more attractive for private equity buyers. And these types of companies clearly have the ability to outperform, ability to generate outsized returns, hence why private equity is interested in them. Some of those characteristics might, for instance, include being high-growing companies, profitable companies that are generating a lot of cash flow. Going back to what a private equity strategy is, it's typically called a leveraged buyout, meaning that these private equity companies are looking at companies whose balance sheets are likely under-levered and have the ability to withstand what they'll call more of a capital optimization of taking on incremental debt. And so therefore, these companies have to be generating enough cash to service those debt payments. And so part of this is, so going back to companies that are growing quickly, companies that are profitable and cash flow generating, and companies that are of a certain size that it can be acquired in whole between the equity investment from the private equity firm and from the debt that is taken on in terms of that leveraged buyout. And so when it comes to public equity companies, if there are public equity companies which are, again, going to be more likely to be small cap companies typically, if there are public equity companies that fit that mold, that fit that ability to be high growing, have really compelling cash flow generation, and where there are certain strategic decisions that can be made to generate outsized value for that company, well, that might be right in the sweet spot of what a private equity firm is looking for, because there are certain things that can be done candidly in private markets where a company doesn't have to report on a quarterly basis the types of strategic initiatives it's undertaking or growth plans it's undertaking and be judged on a quarter-by-quarter basis. And in the context of being a private company, they might be able to, again, execute on something that is more strategic with a longer-term horizon that allows them the time and the flexibility to execute on those plans that may be a little bit more challenging to do so under the scrutiny of public markets. And so when you think about those companies that would be really compelling private equity targets in the small cap public equity market, if those are being taken out, and those are the faster growing, again, more profitable, more cash flow generating companies, higher quality companies, if you will, that are under levered, gosh, I mean, those are probably the types of companies that have the potential to generate outsized returns for public equity market investors on the small cap side. Those are companies that once they are removed, then it also gets to, well, the companies that are remaining in the public equity markets for small cap equities maybe are less compelling. And so all of a sudden it goes back to, is this feeding into what we're seeing in terms of the continued underperformance of small cap public equities compared to other parts of the public markets? Again, this is as much a hypothesis as anything else at the moment. I think folks are, like I said, doing some research on this to gather the data, but it certainly has been pronounced enough, long-term enough, and I'll say private equity firms have grown large enough where they have enough capital that they can continue to take not just publicly traded companies private, but also where there are private equity-backed companies that are now strategic companies in their industries that can then actually acquire and take a company that's publicly listed private, but it's potentially tagged as a strategic acquisition versus a private equity take private, right? And so these things are happening in the markets in different ways and don't necessarily look as obvious, but I suspect it's all contributing to what's happening in terms of the makeup, the composition, and the types of companies that still exist in small cap public equities.
And then I think to tie it back to another macro trend we're seeing, which of course is AI, I'm seeing a lot of activity thinking about what are the types of companies where applying AI can substantially improve margins, increase efficiencies, et cetera. So then you layer that on top, right, where you think about a whole class of, for example, services businesses, which I think have always been an interesting target for private equity firms. But now you take that whole class of companies where you have private equity firms that are saying, hey, could we take a company that historically has not had great margins, apply modern AI, and now all of a sudden you've got a business that's much more compelling. And so it seems that it even further could potentially open the aperture here for another class of public companies to become private and be taken off the market, as it were.
Yes, and this is, again, probably a topic to be explored for another time, but it goes also into, when we talk about different types of private equity strategies, historically, private equity buyout firms, leveraged buyout firms, were much more likely to do what's called a roll-up strategy, which is buy a platform and then acquire smaller competitors and roll them up into the platform. What we're seeing now is that, precisely to your point about how certain investors are more adept with AI and have a greater vision for how to implement and incorporate AI and improve company operations through the use of AI, those types of investors are more prevalent on a different side of the private equity spectrum, closer to what I'll call venture capital and growth equity. And so what you're actually seeing is now this roll-up strategy that historically has really been the purview of buyout private equity firms starting to be utilized by firms that are executing traditionally venture capital strategies. And so it is, again, a blurring of the lines in private equity markets that is interesting and I think goes back to sort of the overall topic of, as private equity continues to acquire different types of companies in the economy, there are a lot of different reasons for why it's happening and a lot of value that's being created in the interim, and it's all being done in the private markets.
Yeah, it's in a lot of the founders groups that I'm a part of, it's amazing the number of technology founders who were historically building traditional, classic SaaS businesses, for example, enterprise software SaaS businesses, that are now all extremely excited about going and purchasing HVAC companies or property management companies, right? These kinds of businesses that I think historically would have not held a lot of interest for a tech founder, but now all of a sudden, the question of, hey, can you apply technology, modern AI, to these businesses and turn them from boring businesses with low margins into potentially compelling high growth businesses?
That's super interesting. And that is fascinating that it's happening in your founders groups, where it's individual founders who have clearly been very forward thinking in the types of companies they've built previously, that they're now thinking about going into these services heavy professional services businesses.
Yeah, I think what is boring is now exciting. I think, and the flip, no one wants to go build an old boring SaaS business anymore. They want to take over the old economy.
Okay, so boring businesses are the new exciting businesses, but why these types of companies?
Yeah, I mean, you would not normally think of somebody who had spent their life building software wanted to go run an HVAC business, right?
Yeah, exactly.
Doesn't normally.
There might be like a cultural. I think of there being like maybe a little bit of a cultural mismatch there. But anyway, go on.
Perhaps a little one, but no, I think it's that as you think about where can AI make the most impact today, and I think certainly as we think about over the next 5 or 10 or 20 years, right? I think AI is going to make impacts across the board. But as we think about where the opportunities with the current generation of AI, where those opportunities lie, right? We're seeing that AI can do an excellent job in automating tasks where you're operating within a relatively narrow range of topics or expertise, right? That if you can kind of narrow that down and train an AI, for example, imagine that you're running an HVAC business and you have a bunch of phone calls that come in or emails that come in. The range of customer challenges or customer questions or customer complaints is probably actually reasonably narrow, right? There may be a dozen that represent the vast bulk of the customer calls that are coming in. And so the ability then to go, for example, train an AI system on how do you triage those? How do you decide, which of those could be solved with a simple phone call, which is going to require to send somebody out? I mean, do you just think about the amount of effort and time that it takes to send somebody out on an HVAC call, whereas maybe there's an easy fix that can be done with the phone. And then on top of that, you think about the ways in which you can then leverage AI to identify what are the highest margin types of phone calls where you should be making sure you're dedicating immediate resources and your top talent. So I think that it's really this lens of what are the kinds of businesses where the margins have historically not been great because it tends to involve lots of hours of people having to analyze and make assessments and make decisions, and where it is not an open-ended set of customer use cases, right? Like I think you'd be less likely to see somebody try to go apply AI to a general handyman type of business, right? But where it is a more constrained set of customer situations, I think that's where tech founders are seeing an immediate opportunity to come in and apply AI. And, you take a business that might be doing 10, 20, $30 million in revenue, but at very low margins. And, you could imagine doubling or tripling those margins. All of a sudden, that could be a huge amount of value accretion in a relatively short amount of time. Again, applying, not the AI that we imagine might exist in 5 or 10 years, but the AI that exists today.
That's super interesting because I imagine if you're seeing this among your founder groups who are, I'll call it, going to be sort of first movers that are using technology in creative ways, it'll be really interesting to see how that continues to spill out into other parts of the market and how it eventually gets picked up in more systematic ways in other parts of the capital market.
I think it is lots to come there for sure. Well, we covered a lot today. I think we have a number of topics for future sessions to follow on here, but thank you all for joining us this week on The Investment Office. We'll see you next week.